So, how to grow a property portfolio to 6 figures a year without risking your hard-earned money. So, here's the story. I was analyzing multiple clients' property portfolios and I accidentally stumbled across something that changed everything for me. And as a result, my perspective shifted from thinking that in order to be safe, I needed to borrow less money, reduce my debt against the properties over time, and therefore expect a low return on my investment. I think a lot of people, including myself, like when you start a property business, I think that most people are completely fearful because they have a lack of knowledge and they have a lack of experience. And I think this is why this thinking becomes part of our character. And ultimately that personality trait then gets in the way of us actually growing the property business to where we need to be. So like I'm a huge fan of mindset and I'm a huge fan of like developing your character traits to become the person that you need to become in order to achieve what you want to achieve in your life, right? Because ultimately, if you operated and acted exactly like your future fictitious self, who's capable of achieving everything that you want to achieve, like you would already be there, right? You'd already have those results. So I think that this kind of belief that naturally becomes part of people's characters at the beginning of growing a property portfolio. And even, to be honest, some experienced investors that I've worked with and who are clients of mine, they still adopt that belief. They've never really made this mental shift until they learn it, right? And this kind of all ties in with that. So let's look at like the client example number one. So this first client that I analyzed, they had a loan to value of 70%. Their return on equity was 18%, so it's pretty healthy, pretty good. And they had 8 properties that were making them a net profit of £89,000 a year based on 100% occupancy. So you need to note that the model is always based on 100% occupancy when I'm comparing like for like in this example. Now, the property portfolio was structured using a hybrid tax model. This meant that they had some properties owned in their own personal name and some properties were owned under a limited company structure. Now, the property portfolio was still profitable at 5%, 7%, and even at 10% interest rates at 100% occupancy. So this property portfolio was extremely safe because if interest rates rise to 7 and 10% across their property portfolio and they're still making profit, it's pretty bulletproof, like it's pretty recession proof as well. And you know, this is the thing, it's pretty recession proof. Well, it is recession proof and it's very profitable, it's very healthy, and they're highly geared. And example number 2, well, this client came to me. By the way, the property portfolio number 1 here, just so you know, is based in Wales, and the property portfolio in example number 2 for this client is based in London. Now, this client came to me, and when I was analyzing their data, this is how the data showed up. The loan to value on the property portfolio was just 62%, and the return on equity was 5.9%. So a lower loan to value than client number 1 and a lower return than client number 1. Okay. Now, they had 10 properties that were making them a gross profit of £125,000 per annum, again based at 100% occupancy. But one of the problems they had was their properties were all owned in their own name. And so part of my job was to restructure their properties from their own name into a limited company. And we actually managed to do that with this client. We managed to transfer the properties from their own name into the limited company without paying any stamp duty or any capital gains tax to do it. And we did that under something called Section 162 of the Business Incorporation Relief Tax Law. Now, but that's a separate video for another day, okay? So, but the net profit on the property portfolio was £59,854 per annum, again based at 100% occupancy. Now, the reason why in the first example when they came to me that their net profit was only £60,000 a year and the gross profit was £125,000 a year was because of the fact that they owned their properties in their own name and they were a higher rate taxpayer, and because of something called Section 24 buy-to-let tax changes. This client could no longer offset their mortgage interest and their finance costs against the rental income. So that's why you see like a huge drop in profit from the gross to the net. Now, The interesting thing for me, this was the light bulb kind of epiphany moment. When I was analyzing this property portfolio, I realized that the property portfolio was profitable at 5% interest rates, but it wasn't profitable at 7% and 10% interest rates. In fact, what I analyzed and what I saw was that at 10% interest rates, this client actually was going to go bankrupt, and they were going to be losing £115,000 a year, even if the property portfolio, if the occupancy rates across the property portfolio were 100%. So this was like the analysis for me. This was the epiphany moment. This is where that shift came for me. I realized that, hey, actually, well, client number one, higher loan to value, higher return on equity, less properties, making more money, paying less tax, and at 5, 7 and 10% interest rates is safer than somebody who's got a lower loan to value property, so therefore less highly geared, has a lower return on their investment, has more properties making less money, and at the same time is less safe. So this property portfolio has a higher risk. And that for me was that epiphany moment, as I say. And you might be thinking, well, how is this possible? It's okay to understand this at a high level and a superficial level and say, okay, well, this happened. But the truth is, like, what we need to understand is how this happened. And as a result of this, I built something called the Asymmetric Model. And this is the framework that I'm using to scale my property portfolio to multiple six figures a year. And it's what my clients use as well to scale their property portfolios to multiple six figures a year. And it really helps us to have confidence in our decision-making process, because I'm a very risk-averse person. So when I make all of my decisions, my investment decisions, when I'm looking at growing my property portfolio, I'm just analyzing numbers. Every single decision that I make within my business is based on data and metrics at the heart of that decision-making process. It takes all the emotion away, and it helps me to focus and get laser focused on the main things. And because I understand the main things that move the needle in the business, and I understand the relationships between the numbers and how different kind of changes and variables affect the outcome of the profitability of my portfolio, I'm much better informed, or I'm more certain, and I have more conviction and therefore more confidence to go and scale my property portfolio aggressively and leverage it in a safe and predictable way than somebody else who doesn't have that knowledge and understanding. So the first thing I want to share with you is, what does asymmetric mean, and why do I use that phrase? So what is the definition of asymmetrical? Well, the definition of asymmetrical is having parts that fail to correspond to one another in shape, size, or arrangement, and is lacking symmetry. Okay. Now, so having understood the definition of asymmetrical, why did I feel that phrase, that word was applicable to my model and a property portfolio? Well, what I've understood from building the model is that there is in fact no linear pattern or relationship between the numbers when assessing the returns on a property portfolio using math. So what do I mean by that? Well, if you think linearly, like how most people would think about this, they would think that if I were to invest in a property portfolio, typically speaking, if I was to make an investment decision, if I borrowed less money and had a lower return on my investment, I'm going to be safer than somebody who's borrowed more money, is more highly leveraged, and makes more profit. So because we're all taught that, like, higher the risk, higher the reward, right? Well, in this case, actually, lower risk, higher reward, safer over lower returns and something that's perceived to be safe. It's the opposite way around at times. It doesn't happen in every situation, but I've proven with this framework in this model that actually there's a number of times where we see this when analyzing portfolios, and this is why the framework I've used has helped me to grow the business and has helped my clients to grow their property portfolios too, in a safe way, which is based on predictable outcomes. So let's go in and actually take a look at the framework and the model and the spreadsheets, and I'll show you the two examples. So in the first client example, I'm going to actually run you through from a really high level here how this works and how it's been built. But I'm not going to go into the granular details and do a live working example. I'm going to create a separate video on that. So if you stick around to the end of this video, there'll be an opportunity at the end of this video for you to be able to basically get access to this spreadsheet. So client number one then. So the first thing we do is we put in their property addresses in the front end of the model. Now, for the purpose of this video, and because it's being shared with lots of people, and because we care about our clients' data and our clients' privacy, I've taken out the client's property addresses, and I've also used example one instead of the client's name for that reason and that reason alone. So then the first thing we do is we look at like what is the ownership? How is the property owned? Is it owned in your personal name, joint names? Is it in a limited liability partnership, or is it owned in an SPV? So you can see that across the 8 properties that this particular client had 2 properties in SPV. Sorry, 5 properties in SPV, sorry, and 3 in their personal names. Had to think about that then. And then what is so they're running a hybrid model, as I said in the earlier document. Then we just look at what is the property types. We have a drop down menu and we put in the different property types. So you've got all the property types of that here. Then we just put in the number of the bedrooms, and again we've got the drop down menu for that. Okay, and then we put in whether it's a mixed use or commercial or whatever it might be. So we've entered that data in there. Then the next thing we do is we look at, is the property a freehold or a leasehold? We put that in there. We put the number of years on the lease if applicable, not applicable if it's a freehold. When we purchase the properties, what lender we use for the property purchases, and therefore what is the interest rate on those purchases as of today's scenario. We look at the current mortgage terms. We look at when we're going to remortgage or refinance the asset. Now again, 2 ways we can remortgage or refinance an asset. One is by buying a property, adding value, and then refinancing from the refurbishment, from the increased value, under what we call a buy, refurbish, refinance model, as some of you watching this video may be familiar with. Another way to refinance the asset is just to wait for the capital growth over the years to do its job and inflate the property, and then we can pull cash out that way. Now, then we look at the property type. So is it interest only, is it repayment, or is it capital and interest? Well, in this situation, this client had pretty much all of their properties on interest only 1 was on repayment. Then we look at the use class. And the reason why I'm showing you the model and the framework is because all of these variables actually determine the outcomes of building a portfolio in a safe and strategic way. And these variables affect whether it's safe or whether it's not safe. It's not just the numbers, it's the strategy. It's the strategies as well that affect those outcomes. So we look at the strategies and we look at the blended approach of the strategies so we can get the whole picture of the model. And we have a drop down menu here for all of the different models. And then we look at the purchase price, the current values of the properties, the capital gain across the properties, what the current outstanding mortgage balance is, and therefore what the loan to value is against the properties. We look at the equity across each property. We look at the rental income across each property based on 100% here. We can always change these numbers to 60%, 80%, so that we can change the occupancy rates and the variables to see what that does with the model as well. And then we enter in our cost of our mortgages. What is our interest only mortgage or full repayment mortgage costs? Our management fees per month, our monthly operating expenses per month, and our service charge and ground rents per month. And what therefore is the profit per month, what is the profit per annum, therefore what is the return on equity for each property, and what is the debt coverage ratio across each property as well. Now, if you don't understand some of this terminology, don't worry, I'll explain it over in the next slide in a second. So we enter all the data into here in the asymmetric model framework, right? Then what we do over Leaf, we have a property portfolio dashboard. Now, kind of the best thing about this model is that when we enter the data in here, it starts to change all of the data in here. So we never touch the data in here in the model. We do all of our modeling in here, all of our financial modeling, all of our variables, all of our what if scenarios we can model in here, and it will run all of the metrics within our portfolio that help us make the decisions as we scale it out under the asymmetric model framework. And this is what I use to grow my business on a daily basis. I'm always in here adapting the numbers, thinking about different scenarios, and I've always got my pulse on on my finances, because if you're like me, like I'm pretty risk averse, so I want to know that what's going on in my business at all times. And often, just to be completely transparent with you, like we work with a lot of high net worth individuals, we work with a lot of business owners, and we work with people that have existing property portfolios up to £20 million as well within the business. And I can promise you from observing and working with these clients that not one of them, honestly, has built out a model in this way prior to working with us and hasn't thought about the metrics in this way. And from working with these clients and working with people as well who are brand new to property and helping them scale their property portfolios from complete scratch, I understood that the variables across the portfolio, having looked across the different variables, I understood where the patterns were and where the discrepancies were. And therefore, from helping those people solve those discrepancies and building them into the model, I've come up with this framework that helps pull it all together. So in this front end dashboard, what it has over here is we have, it looks at the value of the properties accumulatively across the portfolio. Again, the mortgages, the equity, the loan to values, the max loan to values, and the interest rate on the first part. So we can see that this client in this example had £1.6 million of property and £500,000 of equity, which was 70% loan to value. Now, they were making $89,000 a year, 18.09% return, as I said on the previous document, and their debt coverage ratio at 5, 7, and 10%, they were extremely profitable as well. So that's all in the green. Now, what do we look for? Our metric down here is that we're looking for 145% from 7 to what the interest rates are today, and then at 10%, we're looking at 125%. Now, for your own understanding of this, like the banks look for 145% at 5.5% interest rates. So again, I told you I was extremely conservative and I'm extremely risk averse. But this is what's enabled me to grow my portfolio to multiple six figures and do so in a safe and predictable way by adopting this approach. Now, what is debt coverage ratio, by the way, as well? So what debt coverage ratio means is we look at what is the total combined the total combined monthly rent, and then what is the total combined monthly mortgages that you have to pay against the rental income, and we look at that figure. So what this is saying here to us in this cell is that our rent of £14,100 is 403% greater than our mortgage interest payments every month of $3,500, right? So it tracks all of these things, and it tracks all at 5, 7, and 10%, so the different variances on stress testing. It looks at our fixed operating expenses within the business, which is our management fees and typically our monthly operating expenses, and then we look at our monthly gross rental profits cumulatively at today's rates, 5, 7, and 10% interest rates against the debt, against the portfolio loan to value. And then we also look at this at the annual gross profits as well. So again, in this example, client number one, you can see that this client making £89,000 a year net on today's interest rates across his portfolio, and at 5%, they're making $72,500. At 7% interest rates, they're still making £48,000 a year. Now, for the clarity and to put this in perspective, that is like £1 million pension. Like £1 million pension is going to pay you around $48,000. I mean, my dad's £1 million pension only pays him $36,000, but we have independent financial advisors that we work with in-house in my business on a day-to-day basis, and I know from experience of working with them that £1 million pension is going to pay you roughly between 40 and 50k at best, right? So even at 7% interest rates, if market conditions were to change, on a variable at 7%, we're still making £1 million pension. And then at 10% interest rates, well, we're still making $13,500 a year. This model, again, just for clarity and just repeating myself here, but just want to make you really understand this, is that this is all based on 100% occupancy levels right now. So at 10%, and as long as this person's property portfolio was still completely occupied and fully occupied, we're still making £13,500 a year. So this is how it kind of works. And any variables that we change in here, so if I change a variable in here, if I run a what-if scenario. Now, what are the what-if scenarios that we have as property investors? Well, as we scale the business, we're looking at, with the accumulated profits that accumulate in the company every year from our rent, what do we do with that? How do we best invest that? Do we buy one property? Do we scale it and buy 5 properties? Do we buy 2 properties and then from those profits pay down the existing other mortgages. Which mortgages do we pay down, right? We have all of these decisions to make. We have all the decisions to make about what's the next best properties type, what's the next best property strategy that we should use to scale the business out in the most predictable way that's going to give you the returns that you want on your individual circumstances. And what this model allows you to do is it allows you to run all of those variables, and it will track everything within the portfolio and all your metrics as a combined total. So that's kind of from a very high level overview of how it works. As I say, there's going to be a more detailed video and I'll go through a live working example with you. So if you subscribe to the channel, you'll be notified, you'll get notifications, and you can go and watch future videos if you like this video, and you can see how this dashboard works as a live working example. But with that being said, like, that's the first example, right? So that's the first example. Then the second example, as I said in the earlier slides, you can see again that this property portfolio over here, when I'm analyzing the portfolio for existing investors, I look at the tabs in yellow. I build these out for them, and I basically look at where's the opportunities to expand the business, and anything in yellow is what I've deemed as an opportunity to utilize to scale the business and utilize it in this scenario as an excellent tax planning opportunity as well. Again, taxes and everything else is for other videos. So then we have capital gains at the back as well, and then on the front of the dashboard it tells us what's going on in here. So with this specific client, £5.5 million worth of property in London, £3.5 million worth of mortgages, £2.1 million of equity, and 62% loan to value. So more equity than client number one, lower loan to value than client number one, yet he's making £125,000 a year, which on a gross profit margin is bigger, but actually on a net profit margin, actually, when this becomes £60,000 a year because of the taxes that this client had to pay, it's a lot less. But even at gross profit at 125, they're still only making 6%, where the other client was making off £500,000, they were making £90,000 a year tax free and 18%. Right? So these variances make a huge difference to how to build out a property portfolio, and it helps us understand that actually, well, lower loan to value here, making less money is giving us a lower return, and also look on the debt coverage ratio is riskier. Remember in the client one example that these were all in the green, they were all above 125 and 145%, whereas this client at 7 and 10% look is in the red. They're at 119 and 83, so they're actually at a higher risk with a lower loan to value. Now, when we look down the property portfolio here, the biggest thing to note, the biggest swing in this client portfolio is this. They make 125,000 a year today gross, 60,000 net. They make 57,000 gross at 5%, but at 7%, look, they lose 12, call it 11.5, 12,000 a year, and at 10%, they're losing 115,000 a year. This swing from 125 to 115 is so aggressive. It should never look like this. But the truth is, most people, and I didn't do this when I first started out, like I certainly didn't use this framework. When I started out, I was just buying properties piecemeal as well. But then I realized it was a business and I needed to build systems around the business and start to build actual dashboards and sheets that tracked all of the properties. Because sometimes a property on its own can make sense, but then when you put that property into the whole business model and you analyze all of the metrics, it just no longer makes sense. And I was realizing that, well, actually with every client I've worked with, if I ask them for the cash flows or the actual financial modeling against their existing property portfolios, they don't have all of the information that they need to be able to make the decisions. And that is why they end up with lower returns than they want, paying more taxes than they want as well, and end up with a riskier portfolio than somebody that we can build a property portfolio out with from scratch as well, and do it in the right way and just start building it using the asymmetric framework model to start. So, that shows with data, that shows that actually, going back to this, that actually when we grow a property portfolio, like lower loan to value, less debt does not mean a safer portfolio. And in actual fact, there are instances and many times where you can be aggressive or seem to be aggressive at 70-75% loan to values, keeping to expand your business, scaling the business faster, and you can still be safer in the process. And the reason that happens is from the asymmetric model. We build it out in a strategic way. And like I say, here's the problem and here's the solution. The solution is the asymmetric framework, but this is the problem that most people face. The problem is most people think of growing a property portfolio in a linear way. They say things like having a lower loan to value on a property portfolio with lower yields and lower returns has to be safer. And as a result, they apply the philosophy of trying to pay down mortgages to reduce the borrowing across the property portfolio, thinking they are being conservative and lowering their risk. Now, in my experience, this is not always true. And as I've said, in fact, in most cases, it can be the complete opposite. Now, the reason why the framework works is because it tracks all the different metrics on a like-for-like basis, and it takes into account different locations as well. It considers the locations because we track the yield. Now, location has a big impact. Location has a huge impact onto whether your property portfolio is safe at higher loan to values or lower loan to values. So one of the reasons why in this worked example, client number one was safer, even though they were taking out more debt and was leveraging more aggressively, was because that they was investing in Wales and not London on the specific strategy and also the specific location that they are investing, right? Now, the model also accounts for different strategies, and this is the key. This is where the asymmetry is, and this is why you can't generalize here. You have to use a model to be able to specifically run the variables, and the variables will honestly change on every single person's unique circumstances, every person's unique portfolio, and every person's unique goals are completely different, and therefore we build the asymmetric model framework to that person. And this is why it works so well, because it can account for all of those different variances. And the model builds in the stress test analysis too at 3, 5, and 7. Sorry, at today's rates at around 3, 3.5 in a limited company, 5, 7, and 10%. And you can easily run the model across different occupancy levels too. So it tracks location, yield, it accounts for different strategies, the model builds in stress test, and it looks at different occupancy. Now those variables, all of those variables drive the outcomes of whether it's safe or not. And all of those variables are not linear, right? It's not this location with this yield, with this loan to value is safer than another one. It doesn't work like that. It's asymmetric, and all of these different variables don't make logical sense. And I've learned in business that actually most things that are logical just aren't logical. Like the things that work best in business are honestly usually things that are illogical and we don't think of in the first instance. So yeah, anyway, that wraps up the training. I hope you found it useful. If you found this training useful and you liked it, please go ahead and click the like button. That would really help us attract more people to the platform and the channel. And I'm inspired to deliver as much value as I can to help you guys grow your portfolio. I will continue to share insights that work for me purely. I'll tell you what I'm doing, why I'm doing it, and hopefully that may help you on your own property journey as well. If you haven't subscribed already, please hit that subscribe button, ring the bell. You'll be notified of any new notifications of new videos that we put out. I'm constantly putting out new content on a weekly basis. And guys, leave comments in the section below. Give me a comment if you liked it, if you found it helpful. Let me know. If you didn't find it helpful, you equally let me know too. Give me some feedback. And if you want access to the portfolio dashboard, the spreadsheet, just comment me in the comments, and I'll get my team to send you one. All right. So thanks so much for watching, and we'll see you in the next one.